I'm so glad you're with us here on the Clark Howard Show. You know, our mission is to serve you with advice and information that empowers you so you make better financial decisions in your life. And one decision I hope you've already made is to sign up for one of our free newsletters at clark.com. We've got daily trusted advice for your wallet. It'll come straight to your inbox. Just go to clark.com/newsletters to see what it's all about. And today, I want to talk about something I was excited about that is failing in the marketplace. That's right, I can get all fired up about something, and it turns out to be a big fat fail. I'm going to share something with you today, what it means for you, your money, and also your health. And then later, I want to talk about a day coming very soon where you look over at one of those 18-wheelers, tractor trailer, and you see nobody in the cab. Yeah, it's coming to an interstate near you. So I have been over the years excited about what CVS did years ago and steadily expanded with their Nurse in a Box program that they've now changed the name of to, I think they call it Health Hub now. And this is something that started off really promising. Walmart then decided to open health centers all over the country. And they launched theirs much later than CVS, doing so 5 years ago. And it stalled out at 4 or 5 dozen locations, which is nothing when you consider the size of Walmart. And now Walmart's shutting all theirs down. CVS has reoriented theirs. Walgreens long ago gave up and went a completely different direction. Let me tell you why I love these and why I mourn their passing. So many of us as Americans do not have a regular primary care doctor. So somebody gets sick, and you've been left with going to often an urgent care, which bills like roulette. You have no idea when you go to an urgent care how much or how little you're going to pay. And what I loved about the Walmart health centers, and what I loved about what CVS was doing with Minute Clinic, that was the original name, was you'd go there or you'd look online and there was a price list. You saw what everything was going to cost. And it wasn't a range. It was like, you go to be seen because you got a cold. This is what it's going to cost. You go because you need this, that, or the other. This is what this, that, or the other cost. And with the Minute Clinic at CVS, you were able to make an appointment for a particular time, same day if available. And it was very much like how the regular marketplace works for any other business. You see the price before you buy something, and it was reliable. You go to an urgent care, and what are you left with? You're left with who knows what the cost is going to be, and depending on how busy or not they are, you don't know if you're waiting a little bit or a long time, and it will almost always be far higher than going to see a regular doctor that you are a patient of. So with the Walmart and the CVS, and for a brief minute with Walgreens, they all had these places that were perfect for you when you were ill and you needed to be seen and you needed it to be affordable. Well, maybe it was affordable for us. It wasn't for any of them. So they've all bailed on that business model. Walmart shutting down all of their places. And then you've got CVS morphing into a whole different kind of health hubby thing that does more than Minute Clinic did, but also the pricing is no longer transparent. And being able to get the appointments like you could before doesn't work the same anymore. So the costs are more, the costs are not clear at CVS. Walgreens got out of that business, and it's all a big jumbled mess for you and me as consumers. So the real problem here is a dual problem. We have a shortage of primary care health providers in the U.S., and that shortage is quite large. So it's not like you can just call up a regular doctor practice when you're sick and say, hey, I'm sick, will you see me? You need to think about being proactive. And when you're well, not when you're sick, establish as a patient with a primary care practice. And again, they're not trying to be in the now failed Walmart Health Center business, or really the morph to not be the same thing, CVS health business. They're a whole different thing. And what's great about it, if you do establish a relationship with a primary care doctor or facility when you're well, is that when you're sick, they already have a file on you. They know who you are, and hopefully you can get in to see them on a timely basis when you are ill. But continuity of care is one of the key things to long-term health, rather than scattershot going somewhere when you're not well. And so this is something you can't be passive about. You can't wait till you're sick to try to deal with this. And you'll be really sick if the way you deal with something is going to urgent care or a hospital emergency room. By the way, a lot of these urgent cares are now owned by hospital systems, and they've run up the bills where just a simple visit sometimes can be in the thousands of dollars at a freestanding urgent care, and that can be brutal for your wallet. So think about what I'm trying to get you to do. Active, not passive. Get that primary care thing going, and then when the chips are down, you got the place that you know and you trust. Krista?
Okay, Billy in Georgia says, a neighbor whose backyard and house back up to my backyard and house has an 80 to 90 foot tall dead pine tree.
Oh, at least it's not a hardwood.
Which I've pointed out could do significant property damage and possible personal injury or death to an individual. He is not committed to addressing this problem. I've brought this to the attention of my insurance company and have documented communication with my neighbor regarding this situation. What else should I do?
So this is going to be impossible to do this politely. This is a danger to health and safety, as you said, and life and safety. I would send a certified letter to the individual. Just the act of sending a certified letter is unfriendly. So make the tone of the letter as friendly as possible. Hey, it may have slipped your mind about that dead pine tree. I'm really worried about it. Killing somebody in your house, killing somebody in our house or another house. Could you please address it before it harms someone or kills someone? And you say please and thank you and all that. And so the tone of the letter is not to be threatening. The tone of the letter just lays out the facts and the fear. And you send that because you say you've documented. There's no documentation like sending that. And this is important for you building a case. Now, you do have the right, if there are dead limbs from this pine tree that cross over onto your property, because a tree, the base of it can easily be on one person's property, but part of the tree, the limbs, can go on another person's property. You have the right to have the limbs removed that are of danger to you and the branches that are of danger to you that are on your side of the property line. You don't have the right to touch the tree on their side of the property line, but you want to do everything you can to, in every way possible, to be politely assertive with your neighbor about this. The neighbor is taking a dumb risk because the liability issue here is great, but the risk to life and limb is obviously greater.
Ivan in North Carolina says, please explain how people lost their savings around the 2008 financial crisis. Do we need to be concerned about our investment accounts if we use one of your 3 children?
Okay, my 3 favorite children, Schwab, Fidelity, Vanguard. It is an expression for 3 behemoth financial houses that none of them are perfect, but all 3 do a great job of providing low-cost access to financial markets and wonderful financial products of various types. They each have their own different personality. So during the aftermath of the banking scandals that led to the financial crisis, my 3 favorite children, money was completely safe with my 3 favorites. But people lost money because as a result of the banking scandals, we had a stock market rout that was bad, ugly, that we came out of, that we hit the bottom of in April 2009, if I'm right. And between when the banking scandals erupted in 2007 and 2009, people lost enormous sums of money in their holdings if they sold. But there was no loss of money except paper loss if people could stomach it, rode the markets down, and then back up. The actual money that was lost was an enormous amount of money that was in bank accounts that was not federally insured, accounts of businesses and mostly wealthy individuals that exceeded FDIC insurance limits. An enormous number of banks, our central bank, the Federal Reserve, and the banking regulators chose to save certain banks they designated systemically important, and they let a huge number of banks in the United States go insolvent and fail. And so a lot of people lost their money in those circumstances. Other lost money, obviously, was because of the reckless and criminal behavior of so many banks and financial institutions. It led to the wave of foreclosures that I think was in the millions. And so a lot of people got wiped out. The value of their homes got wiped out, eventually recovered. And the problems we have in the housing market today, almost without exception, you can give a huge percent of the problems because of the banking scandals, that it destroyed most of the builders in the United States. And so the production of homes in the U.S. collapsed because of the banking scandals. And the reasons we're having so many problems with the housing market today go straight to the banks.
And Chad in Oklahoma says, with the change to merchants starting to charge a convenience fee, what should we use to avoid this fee? I never carry much cash, and I know Clark hates debit cards. What about online transactions?
So the marketplace is still sorting this out. And at this point, the number of retailers and restaurants that are charging fees for using credit cards is pretty small, but it's going to rise and it's going to differentiate. So depending on which card you pull out, the fee will be higher or lower. The real answer to this is for the Congress to do what they should have done long ago, and that's to extend to consumers the same protections with debit cards that consumers have with credit cards. Then it would be a slam dunk. If you go to a register or you're at a restaurant and it says, oh, you use that American Express, it's 3.7%. You use that particular kind of Visa card, it's 2.9%, whatever. You could turn around and use a debit card and pay potentially nothing, or pay, it might be 30 cents or something like that. Just a pass through of the merchant costs. So this is something that is a problem that has a very simple solution. And that is, what happened was in the 60s, when credit cards came of age, the Congress was not subject to so much influence from the lobbyists as it is in more modern times. So the Congress chose to put in place no consumer protections for debit cards, and that's why you have greater risk. This is one of those things that's a hard one. So if it were me, what would I do? I have an ATM card that has a Visa logo on it. I've never used it for anything but drawing out ATM money. And I've been thinking this through, and so I'm so glad that you posed this question, because I have made the decision that when there's now going to be a fee, I'm going to, for the first time ever, use my debit card and know the risk that comes with it. The smartest thing to do is, if you're going to do that, because of the lack of protections under the law, is to set up a separate account, maybe with an online bank that charges no fee, something like that, that ties into a debit card. And then the only money at risk is the money that's your regular walking around money. You use a debit card to pay for things, as that it becomes so much more common that you're assessed fees for using a credit card. And again, this will become routine. It'll be a gradual thing, and then all of a sudden we'll be like, oh, everybody's charging these fees now. And then you're going to wish for an alternative payment system. The day will come that Apple, with its large ecosystem, whichever it is in the United States, will have their own payment platform. I'm not talking about Apple Pay, but I mean where you actually will pay some form of Apple debit. Google may launch something like that as well. We will have alternatives to the banks. This is why the banks are so stupid. This beat up on the bank segment. That the banks use their lobbying power to prevent consumer protections for debit cards, because by not giving people a safe harbor using a debit card, they give people a reason to look for alternatives to using a debit card to pay with. So it's really short-sighted of the banks to feel like they got some kind of victory sticking consumers with the risk with debit cards that consumers don't have with credit cards. Enough about picking on the banks. For now, just for now. Coming up ahead, whether you want it or not, automation is coming to the highway. Recent survey shows that roughly 2/3 of Americans are freaked out by the idea of autonomous vehicles running around on the roads. And, this is a technology that's been talked about for a long, long time. And it's been much in the news with driver assistance stuff, semi-autonomous stuff that Tesla and GM and Ford offer, about spectacular accidents that have happened with their autonomous systems. Those all are driver assistance systems where a driver's still behind the wheel. And I've been driving a car with these assistance things, the autopilot kind of stuff, for 7 years. And I've seen the technology get better and better and better, but it's still not perfect. I drive a Tesla, and they, earlier this year, went to a new software mode that it does so much better than it's ever done, where it drives me on surface streets, handles four-way stop signs, red lights, all that stuff. And it's really good till it's not. And what's terrible about this mid-grade automation is that you get to the point where you trust the vehicle too much, but I'm fully responsible as a driver. And that is a way station to where we're headed. And you're going to see later this year, and if it's delayed, it'll be by months, not a long term, where tractor trailers, over the road haulers, are going to be fully automated. There will be no one in the cab of the truck. And these systems have been tested for more than 10 years. Because the problem is, think about when you're on a road trip and you're on the road 10, 12, 14 hours in a day. You suffer from what's known as highway hypnosis. You get distracted, you get into a zone. They call it the fugue state. I don't know what that means exactly, but you just kind of zone out and you may nod off. And you see it on the road when people suddenly are hitting those rumble strips on the side of an interstate or whatever because they're sleepy or distracted or just exhausted. So the reality is, over-the-road trucks will, over time, be much safer, not in-town delivery trucks, will be much safer with full automation. And it is going to happen. And it's going to be happening, let's say, by the fall of this year. It's pretty clear from published reports that it's ready for prime time. So this is one of those things that's a change that is really, really hard. Because a lot of times if you're holding the wheel of a steering wheel, you feel in control. But you're only in as much control as the other vehicles around you. And so I'm looking so forward, having had 7 years experiencing a car doing more and more of the driving and decision making for me. I'm really looking forward to the time when I'm just transported and not driving. People who want to keep driving will be able to. And we are in a messy decade for this. But just know it's coming. You're going to see that truck next to you, and it's going to look like the person's asleep, laying down, but there is no person. It's driving itself. Does that freak you out, Christa?
Not really, no. But it was funny while you were talking. We record, right, we can see the Consumer Action Center, Help Center, which you can find out more about at clark.com/CAC. And they have some TVs on. And while you were talking, there was a news story, Tesla full self-driving being scrutinized.
Well, I mean, that's all an Elon Musk problem, because Elon Musk so overpromised over and over again what the autonomous driving would do. And so he's kind of like Pinocchio at this point, but he's also brilliant. And what they've been able to do in a really short time is amazing. When you're on a highway trip in a Tesla with its what's known as what do they call enhanced automation? Enhanced autopilot. The car drives so much better than I could as a human. It's not even close. Perfectly down the lane, handles passing other cars perfectly. I mean, it is something that is a breakthrough that's happening, but we're all guinea pigs right now.
All right, we'll go to some questions. This one came in from Steph in New Mexico. Would it be worthwhile to create another email to use exclusively for my financial websites, bank, brokerage, etc.? I've been using my current email for years for everything. I've just started to use the duck.com email, but I'm not sure about using it as my main email for financial accounts.
So DuckDuckGo is in emails now too?
Yeah, they have like a beta thing, duck.com.
Oh, DuckDuckGo is such a great search engine because they're not spying on you all the time. And the results, they're getting better and better at the algorithm of results for search. And now they've got email where they're not spying on you. I love that. And I love the idea of you using an alternative email, Proton Mail, Duck's Mail, anything other than your primary email cordoned off for your financial sites. That is really, really smart because we tend to be creatures of habit. We develop habits and how we come up with passwords and all that. I'm using a password manager that gives me these crazed passwords that show no pattern one to another. But the idea of taking your bank, brokerage, retirement account stuff and putting it with its own email address, I think that's really a great concept.
Emily in Colorado says, my husband and I have been living in our current home for a little over a year. We locked in at 5.125% interest rate, and we have $266,000 in equity. 13 more years and this home would be paid off. But our home is pretty small, and while it works for now, as our son gets older, we can see the need for moving to a larger home. The area we live in is really expensive with limited land to build new homes. Right now, we can get a new home from a national builder for about $900K to $1 million that would suit our long-term needs. The builder is offering a 3/2/1 buy down on the mortgage rate, so 3.99 year 1, 4.99 year 2, 5.99 year 3, and 6.99 year 4 through 30. Years 4 through 30. If we know we want to live in this area for the long run, does it make sense to sell our home and move now or wait?
This is a lifestyle choice and decision for you. You did this current loan, sounds like you did a 15-year loan. You got a below market interest rate on it, where interest rates have been. And you know you're going to need a larger home at some point. This is really your call. I can tell you're really careful with how you handle money. I would go back to the national builder that's offering you 3-2-1 buy down and see if they have an alternate buy down that would buy the rate down instead of going down to 4% first year, I guess I should say technically 3.99%, followed by 4.99, followed by 5.99, and then the 6.99. It would actually be better if they did a one-time buy down to a 30-year rate rather than the teasers moving up. So if you could get them, and it probably costs them similar money, if you get them to buy you down from, let's say, 7% to 5.75 or something like that, and that would be for the 30 years, that would be preferred for you versus the 3-2-1 buy down. Lenders are doing both. Builders are doing both, but they're usually doing one or the other. It would not hurt to ask this builder if they'll do a simpler buy down to not as low a rate, but one that stays fixed for the 30 years, because that's what is more important than having a very low teaser for years 1 and 2 and 3. And so as far as doing the purchase, you got a lot of equity in the home you're in. You're going to go up a couple of interest rate points. It's a long-term play. I think it would be okay if you wanted to do that. And anything about that you feel like I'm missing?
No, I mean, it sounds fine because we don't really know what interest rates will do.
Well, because you're always going to have the chance, if interest rates do decline, which I believe they will as we get out of this inflationary cycle, you'll be able to refi. Refi is not free, though, but you'll be able to refi. That's why I'm more interested, though, if the lender, instead of the 3-2-1, will offer the one-time buy down from what market rates are, a point or so. That would be more long-term benefit, and then rates would have to fall significantly before you'd spend the money for a refi.
Anonymous in Florida says, Clark, my 15-year-old grandson, who has been homeschooled all his years, has no interest in schoolwork. He's working full-time with family and has grandiose hopes and dreams. We grandparents have encouraged him to at least get a high school degree or GED or attend trade school to no avail. What would you say or do to make him understand the importance of an education?
So I'm thinking about what you just read me, Christa, and obviously the real disagreement is between the grandparent and the parents. That Anonymous, your kids, your kid and kid-in-law, don't value education. As a 15-year-old is not at an age or maturity level to really understand the implications of dropping out of high school. And always later, if the kid's sharp and all that, easily be able to get a GED. Now, interestingly about a GED, the data shows that a GED alone does not lead to necessarily increased income. It's what the GED then opens up with going to trade schools, technical college, going to traditional college, that's where the big career benefit and pay benefits come from. I don't know how, if the parents are like, yeah, he's fine, he's working, he's going to be great, and they're not with you on this, how you get it done. I mean, you can only hope that as this 15-year-old, at 16, 17, 18, they're like, oh, I'm kind of dead-ended here. And then they're willing to listen to you, because you can't make their ears open up and hear you right now. But there's no doubt that you're right, that having the education has the benefits of flexibility built into it. There's no automatic magic with having a college degree, and that's why people are reassessing the value of college. It is the training you get, the education you have that opens up doors, opens up so many career possibilities. That's where it's at. And that's what your 15-year-old grandson is going to be missing. But right now, it doesn't feel like the family dynamic is set up for your grandson to receive your very important message. I want to thank you so much for joining us on today's podcast. Know that what we're about is a simple thing. Is all about, and this is what our website's about, everything is about you being more in control in your life financially, that you save more, that you spend less, and absolutely don't let anybody rip you off. And we'll see you tomorrow.